Okay, before we actually get started with the presentation, a couple of housekeeping items. And first is, I'm using sort of a new studio, new software to do this live stream. Hopefully, fingers crossed, it will work well. There won't be any issues. But please be patient with me as I work out all of the kinks. One of the things that it will allow me to do, as you'll see, and in fact, I'll show you now, it allows me to toggle between my screen, showing you what's on my screen versus my being live on the camera. And so it'll allow me to show you a number of things that I think will help kind of walk through today's video. A couple of other things. I'm live streaming this to my own Facebook page, which is a fairly new page, rather than the dough roller group. And I'm doing that for primarily one reason. These live streams are much easier to share if they're on a page versus a group. A group has a lot of limitations. So all of the live streaming going forward will be on this page, and then very shortly they'll actually also be on YouTube. But once the live stream is over, you'll be able to watch it again, or if you miss a live stream, you can watch it again on my Facebook page, or of course on the Dough Roller Facebook group. So if you're watching this and you're not a member of the Dough Roller Facebook group, highly recommend it. Just go to doughroller.net/Facebook group. That'll redirect you to the Facebook group and you can watch it. The final thing is, I mentioned my YouTube channel. In fact, I can show it to you. If we go here, this is it. Right now, it's predominantly just for videos related to my book that I published last year, Retire Before Mom and Dad. That is going to change, and it's actually going to change this month. I have a lot of videos planned on everything from how to use Morningstar. I'm going to do an Investing 101 course. I'm going to do a course for sort of more advanced investing that gets into things like rebalancing, asset allocation, and investing tools, and then just general personal finance content. So that's all coming very, very soon. Again, once I got this studio set up, it's much easier to produce those videos. So if you haven't subscribed to the YouTube channel, highly recommend it. Again, the videos will be coming out starting this month. So looking forward to that. It kind of adds a new dimension. The podcast is still there, still recording the podcast, but with videos, as you'll see today, I can show you things on my screen, and just adds another dimension to everything. So I see your comments. What I'm going to do, we're going to start the substance of the topic in just a minute. I'm thinking of the last 15-ish to maybe 20 minutes, but we'll see. I haven't actually done a dry run. But then after that, I will still stay on the live stream. I see your comments coming in. We can, I can get questions and topics from you, and happy to do that. So that's it. That's the plan. So let's jump right into it. As we all know, the market's been kind of crazy, and I thought now was an important time to sort of address where we are in the market, what's going on, how I'm reacting to it, how I think long-term investors should react to the market, the things they should do, what they shouldn't do. We're going to talk about things like, is this a buying opportunity? I've heard that from a lot of folks. They've got some money on the side, or some money they want to invest, and they view this as a buying opportunity. And we're going to talk about that and what that means, and is it really a buying opportunity or not? And towards the end, I'm going to address two sort of important topics for our time. And that is this now a good time to start investing? Maybe you've never invested before, you've been thinking about it, you were planning to, and then all of a sudden all this craziness happened. Should you invest now, or should you kind of wait? It's a question I got recently in the Facebook page. I want to address it. And then after that, going to talk just for a minute to those that are already in retirement, because that can be, I think, arguably the most unnerving time when you're going through markets like this, when you're no longer earning an income, you're relying on your nest egg for your expenses. What do you do with that? How do you handle this market? I've got some things planned on that topic. I'll tell you about that at the end. All right, so let's get started. And I think where we should begin is kind of what's going on in the market. What's it look like today and over the last few weeks? And to do that, I'm going to show you my Apple stock app. Actually, boy, if we look at it today, I don't see what all the fuss is about. Things look pretty good unless you invest in Citigroup, which I do, but that's a topic for another day. The S&P is up so far almost 4%. It was up much higher than that a little bit earlier. Doesn't look so bad. Of course, I know what you're thinking. It's like, Rob, I think we need to zoom out just a little bit to see what's really going on. That's actually the theme of today's presentation, and we need to zoom out a lot. But for now, let's take a look at 1 week, and we can see that things start to turn red pretty quick. At the beginning, if we go back a week, the market was around 2,800 for the S&P 500, and now we're down to just under 2,500. Of course, if we zoom out even further, 1 month, we can see that we were well above 3,300, close to 3,400. And so now we're down, maybe 900 points on the S&P 500. And of course, as I'm no doubt sure you know, we ended up from the top going down by more than 20%, which is sort of the official definition of a bear market, right? And so we are now officially in a bear market. And things seem kind of, scary. That's why we're having this video today. Now, I like to always zoom out even further. If we go 3 months, still red. 6 months, still red. A year? How about 2 years? Yikes. We've got to go out 5 years before the chart turns green, and that can seem really unnerving. Now, one thing I'd like to point out is we go back to the 2-year period. We notice this dip down in here. It's like, what is going on here? If we zoom in on it, we can see that in December of 2018, the market was actually lower than it is right now. It was 2351, and today it's at the moment, 2471. And so we may recall there was a market correction at the end of 2018. And so we're actually, as difficult as the market may have been for some of you over the last few weeks, if we zoom out, we're actually still better than we were just a little over a year ago. And the funny thing there, funny may not be the right word, but if we could go back in time to December of 2018, I remember it vividly. Folks were scared of the market then. Maybe not quite as much as they are now, but there was a lot of questions being asked. Is this going to get worse? Are we going to go into a bear market? I think if we knew then that a year and 4 months later, we'd actually be a little bit higher than we were in December of 2018, we probably would have been thrilled. Of course, how we get there affects everything, and as we know, the market has gone down significantly over the last few weeks, and that unnerves folks. So, how do we think about this? How should we think about the current market? Let me kind of zoom back to the last month that gives us sort of the current picture. And how do we think about this market? And I think the very first thing is that we have to acknowledge that what's going on in the world, the coronavirus, the global pandemic, is certainly unprecedented in my lifetime. We've certainly had other issues, diseases that have caused significant loss of life. Even not that long ago, the swine flu comes to mind. 2009, 2010, I believe, it killed, I want to say, nearly 200,000 people. But in terms of a global pandemic that's affected our daily lives, businesses are closing, restaurants are closing, places of worship are closing. That is certainly unprecedented in our lifetimes. And we'd probably have to go back about 100 years to the flu epidemic, pandemic in 1918, really, to have something, obviously not in terms of loss of life, but certainly in terms of scale, something comparable to today. And I don't think we should, even for those buy and hold investors that have, like myself, done absolutely nothing. I've not sold a single share of anything. We shouldn't try to sugarcoat this. I mean, we are certainly in difficult times, but just like we zoomed out on the stock chart, I think it's important to put some of that into perspective. And actually, as I was preparing for today's video, one book that came to mind is this book that I just finished reading. I read 25 pages a day of something, and it allows me to get through a lot of books. And I recently finished Yuval Harari's book, Homo Deus, A Brief History of Tomorrow. And it's certainly a fascinating book. I recommend it. But he talks about pandemics. Actually, what he says is, in history, what tended to kill a lot of people was either war, lack of food, or disease. But that as technologies improved, communications have improved, our ability to fight these things has really significantly altered life as we know it. He makes the point that more people die from eating too much than not enough, that sugar today kills more people than gunpowder. And actually, if we, again, zoom out and we look at health issues over time, we can see that very positive trend. And I think it's worth, at least to put our current events into some perspective, it's worth taking a look at that. And I found a chart that I want to show you that I thought was pretty informative. Here it is. This is an infographic that was recently put out. And it's an infographic of pandemics, going actually all the way back to 165. And you can see some of them, many of them on this list, all of them really, were, I was going to call them significant. That seems like an understatement. I mean, certainly the Black Death, 200 million people died. Smallpox, 65 million. And if we move forward, we can see, for example, if we go all the way up to the Spanish flu, which I alluded to earlier, 1918, estimated 40 to 50 million people died in that as a result of that pandemic. Now, if we keep moving forward, we see that things generally, by and large, get much smaller. And here we've got our current coronavirus, COVID-19. Now, of course, it's ongoing, and I'm not here to predict the future of this virus and what will transpire. But I do think this chart puts things into perspective for us. And I'm encouraged, frankly, by our ability to address this issue. And I know there's been a lot of criticism back and forth about the response, and no response is going to be perfect. But if you think about it, we were almost immediately able to identify that it was a virus, identify its source, identify what it is, and begin to take steps to address it. And we're, of course, really still in the midst of that. But our ability to do that today is night and day different than it was, say, well, goodness, certainly if you go back to, say, the Spanish flu in 1918, and certainly if you go back in time, but frankly, even compared to HIV and AIDS, where it took us some time to figure out what that was and even how it was transmitted. It took a couple years to figure that out. And so, again, I don't say any of this to diminish what we're going through now. And it's obviously very significant, and it's not over. But I do think it's important to zoom out and take a sort of a bigger view of the situation beyond putting blinders on and looking at it through a magnifying glass and only focusing on what's happening right now. So a lot of what we're going to do in this video is actually do that, is to zoom out. So as unnerving as the current events are, and as unique as they are, there's one thing that is absolutely not unique, and that's how the market's behaving. The market is behaving as it does frequently. Now, it may seem unique, and we can certainly point to things that don't happen very often. For example, we were down 10% one day, and then I think up 10% either the next day or the day after, and then we were down 10% again. Some have pointed out that we entered from the peak down to a bear market, I think in 15 days. And that may be the fastest ever. I think the Great Depression, it took 30 days. I'm not so sure how relevant those data points are, but we can certainly look at them and say, yeah, we're not really used to seeing that kind of movement in the market. But what we should be used to, and what we should come to expect as long-term investors, are corrections where the market goes down from its peak by at least 10%, and bear markets where it goes down by at least 20%. It turns out that these sorts of changes in the market, they happen all the time. They're not at all uncommon. The specific events surrounding them and the specific events that cause it to happen are often unique. And as I've pointed out many times in the podcast, often the market changes and the drops in the market are the least of our concern. In some ways, this is for better or worse, a perfect example of that. Our concern is the virus and keeping people healthy. That's our primary concern. But we can go back in time. The last bear market was the financial crisis. It was unprecedented. We thought our banking system was going to collapse. The auto industry was collapsing. People were losing their jobs. People were losing their homes. And so if we could go back in time and look at all of these, the events that trigger it are often very unique. But the fall in the market, honestly, is not really that unique. And I want to show you an example of that. If we go back to the screen, this is from CNBC, a chart of correction. So this would be where the market drops from its peak by at least 10%. And as you can see on the screen, it's measuring it from World War II. And I can drop this in the comments. And you can see that since World War II, since 1946, so roughly 75 years, we've had 26 market corrections. Not exactly unprecedented. The fact is, they happen fairly frequently. I mean, it happened twice just in 2018 alone, as you can see from the chart. And in fact, the September 2018 correction, which I think ended in December as we looked at, it was almost a bear market. Not quite, but it was almost 20%. Now, this is just corrections. This doesn't count bear markets. We can take a look at bear markets right here. Again, same time period since World War II, and there have been 12. And as you can see, they're all pretty significant. By definition, the market has to go down by 20%. And if we add these together, 26 market corrections, 12 bear markets, we're looking at a correction or a bear market about every other year. That's not at all unprecedented. It's something that we should expect. We won't know in advance when exactly. We won't know in advance what triggers it. I certainly couldn't have predicted a pandemic 6 months ago. I don't think anyone could have. So what triggers it will always be scary and unnerving and a surprise. But the fact that they happen shouldn't take us by surprise at all. And if you think about it, if you're in your 20s or 30s and you're going to live to be 90, you're going to invest for, quite a number of years, you're going to go through dozens of corrections and bear markets. That's just a reality. And we need to be mentally prepared for it. And the question becomes, and really the question I want to address in this video is, how should we respond to it? And as I mentioned, they're always scary. So I want to show you one page. This actually is from March of 2009. When we think back at past bear markets, they don't seem as scary as when you're living through them. Of course, we already know what happened. Yes, there was a bad market in 08, 09, but then we had one of the longest bear market or bull markets in history. And I think that takes some of the scariness out of what happened back then. It's now just in our minds, we can remember it, but we're not feeling it like we're feeling the current situation. But if you go back and look, and this was a website, this was Market Watch in March of 2009, it's pretty scary. First of all, job losses gain momentum. Consolidation plans melt chip makers. We see city shares are leveled. This was a scary time. And what's interesting about this date, March 6, 2009, it was 3 days before we hit bottom. Of course, we didn't know that then. And after that, we started one of the longest bull markets in history, but we didn't know that, right? And if you look at the Dow and the S&P, look at the S&P, 683. We forget how low it was. At least I do. The Dow was under 6,600. So these are, I think looking at the history of the market and understanding what happened, I think puts us in the right frame of mind to deal with the current market. So how should we deal with the current market? Well, my view is that we should be long-term buy and hold investors. As I mentioned, I've not sold a single share of anything. And I think that's the only reasonable way to invest for long-term success. But I want to play devil's advocate. I want to argue against myself. Let's say, no, that's not what we should do. We should try to avoid the big losses and then get back in when the market starts to go up. How would we do that? Let's go back to the infographic we were looking at just a minute ago. In order to do that, let's start with corrections. We have to not only predict when the correction is going to occur to get out of the market, we also have to predict when the correction is going to end and the market's going to start to go back up so that we can get back into the market. So we have to get it right twice. And we have to do that over, think of decades of investing, over and over and over again. And that's just the corrections. We have to do the same thing for the bear markets. And here's the thing. If we get one of those wrong in our lifetime, it can affect our wealth for the rest of our life. I know folks who in the last bear market, 08, 09, sold pretty much all of their stocks, waited to get back in, and and realized too late with profound regret that they'd made a huge mistake. And it's affected their wealth and will affect their wealth forever. They'll never make that back up. It doesn't mean that they can't start to make good investing decisions and continue to move forward, but it's going to leave a significant hole in their portfolio. And what I have found is that no one can really predict on both ends of corrections and both ends of bear markets when they're going to start and when they're going to end. Now, that doesn't keep people from trying. And they will try to predict this over and over and over again. In fact, you'll see predictions all the time. And I'll give you a couple of examples. Here's one. Historian who predicted the 2008 financial crisis warns the next recession is near. I've noticed that since 08 and 09, whenever a website wants to run an article about a prediction, they'll find someone who they can say correctly predicted the housing crash to give them sort of bolster their credentials and then lay out their current prediction. Now, one might say, well, Rob, I mean, aren't we really probably in a recession? We won't know for 2 quarters, but maybe he was right. Well, you got to look at the date. This was 2 years ago. He predicted the recession, March 2018. So no, he wasn't right. And here's the thing. There's always somebody predicting something all the time. So as a journalist or a reporter, they can go out and find someone who predicted this current market crash, and then they'll write a story about it. But that doesn't mean that you and I can correctly predict these things on both the front end and the back end over and over and over again throughout our investing lives. And I've met plenty of people who think they can. I've yet to meet anyone who actually can do it. So where I have come, and this is over 30 years of investing, is that I simply am not going to use any market predictions to influence my investing decisions. As I've mentioned before in the podcast, I predicted that interest rates would rise beginning in 2010. I think we can all agree that I didn't get that prediction right. I know that I can't consistently predict these things, and so I don't even try. Certainly don't let them influence my investing decisions. I have an asset allocation plan. I buy and I hold, and I do that whether the market is going up, and some are inclined to put even more into stocks. I don't do it. When the market's going down and people might be inclined to take money out of stocks, I don't do it. And what I've found is, as scary as times like this can be, the markets do recover. And in fact, let me go back to another chart that I want to show you that I think is very informative. And I'll drop the URL into the comments. Well, let me try that again. There we go. Oh, there it is. Okay. So this is just a chart showing a history of some of the worst bear markets that we've experienced going all the way back to the Great Depression. The thing I like about this chart is it shows you what happens afterwards, right? It shows you the average annual total return for the 5-year period afterwards and what that would look like if you invested $10,000 in the darkest days of each bear market. And without fail, the returns following a bear market are quite good. And we saw that firsthand, of course, just a few years ago or a decade or so ago, and it's the one that's listed 5th in this chart. Remember, the total decline was over 50%. Sometimes it's easy to forget that. But when you look at the average annual return afterwards, it was over 25%. if you pull out of the market and you time your re-entry wrong, you lose all of the benefit of that recovery. And so I just don't try to. I don't try to time it because I know I can't, and I don't want to lose that kind of recovery. It could affect my portfolio forever. So the question becomes, we know we can't time the market. We know what happens after a bear market. So why is it so hard to stay in the market? And I think part of it is that the news cycle is so vicious sometimes with the market. And in fact, I can show you some examples of that. Here is the market. Now this is interesting. This is from this one is from April of 2009. So let's think about that. The bear market is over, right? We've started a recovery, but we only know that now because we have the benefit of history, right? In April of 2009, folks were still scared. And you can see this in here. Of course, you see where the S&P 500 was back then, but you'll see things like, this one was interesting to me. Yellen sounds bubble alarm. San Francisco Federal Reserve President warns of ticking time bomb of asset inflation, calling for central bank vigilance. JP Morgan profit off. Bank put aside $4 billion for bad loans. The gaming industry was down, for what it's worth. This was a scary time. And yet what they didn't know was this was the absolute best time to be investing. I don't take issue with any of the stories on the website. They may all be perfectly good stories, but if it's all we focus on, sometimes we can fail to zoom out and take a look at the big picture and truly understand the benefits of long-term consistent investing. Now, there is one thing that helps me stay in the market, and it's that the bear market is the best time. It's the time when what you do has a profound effect on your portfolio. It's the time when making the right decisions can make all the difference. And there's really three reasons for it. They're all related. The one is you continue, let's say, to contribute to your 401k or an IRA, each paycheck, each month, each quarter, each year. In a bear market, as we all know, you're buying shares at a much lower price. And that's often the scary time to buy, right? Times like this. But as we know from history, it's the best time to buy. It may not be the easiest, but it's the best because we're getting those shares at cheaper prices. It's as simple as that. And we don't have to time the market. We can just continue to consistently do what we do, investing again each paycheck in our 401k or each quarter or year in our IRA or however you invest on a regular basis. And as the stock market goes down, enters correction and enters a bear market, you're buying the same shares of the same mutual funds or stocks at a much lower price. That's the first benefit of a bear market. The second is as the stocks and or mutual funds have dividends and they get reinvested back into the market, back into the mutual fund, or however you, most people probably automate their dividend reinvesting, but however you do that, you're buying back in again at much lower prices. Huge advantage. The third thing, and this may not be quite as obvious, but companies, as we know, buy back their own shares. And when they do that, they make each of the shares we own more valuable. We have just the same number of shares, but they represent a bigger piece of the pie, so to speak. Well, we want those companies buying back shares at the cheapest price they can. That allows them to effectively get more bang for their buck. And so each of these things really helps power our portfolio during a bear market. Again, as difficult as it may be to stay in, if you will. But I'm always reminded of these things. And it's one of the things, along with an understanding of the market history and how markets work, that helps me stay invested. Now, you might say, well, Rob, that's all great, but why do so many people not stay in the market? Sure, we can look at history. We understand what's going to happen after a bear market. Fine, we've heard you on the advantages of continuing to invest in a bear market. Why don't more people do it? And it actually is worse than that. I have a number of friends that we talk about investing all the time, and a lot of them don't follow the same buy and hold strategy that I do. They're into 20 positions and then back out. They're trading this option and selling that put. they've got their trailing stop losses, and they're telling me how great those worked because they all triggered and they got out, and instead of losing whatever, 20 or 25%, they only lost 10%. The problem with that, and one question that I ask all of them is, well, that's great. Appreciate that. Interesting strategy. Tell me, what's your compound annual growth rate over the last decade? I can tell you what mine is because it more or less mimics the market. What was yours with all this buying and selling? Tell me your after-tax, after-fee returns. Without fail, I've yet to encounter someone who can actually tell me that. They don't track it. They don't know. And so I asked them, well, if you don't know, how do you know this is a good strategy to follow? Now, I love these guys. We have a great time debating investing. So I should just say, if you're watching this video, understand, I think it's terrific. You and I just have to agree to disagree. But I think it's an important question. All of that buying and selling, market timing, almost, I think, invariably leads to worse performance. But here's the thing. When someone tells you they went to cash and they missed all of this pain, maybe it's a coworker, a friend, family member, it's really easy to sort of get caught up in that and say, boy, yeah, I wish I could have done that. I wish I would have been that smart. The problem is they can't do it consistently. They don't track their returns. And I think almost without fail, the long-term buy and hold investor, particularly if you're investing in low-cost index funds, are going to outperform the active trader. I'll just say 99 times out of 100. Maybe there's one person out there that can somehow do better. I've yet to meet them, but maybe they're out there. But apart from that, the buy and hold strategy is the best. So why is it hard to stay put? Well, again, you've got the friends, as I just mentioned, telling you about how they've sold out. You've got the news, right? And in fact, goodness, we can even go back to the Apple stock app, and we can see that, today has been, I guess you would call it a good day. But as you go through and look at some of the news, it still leaves you a bit jittery. Stocks stabilized after worst day since 1987. Well, that's a little unnerving, right? And sometimes painful. Lessons from a cautious investor. You can see as we read through some of this news that it can be a little unnerving if we focus on it. So I tend not to focus on it. I'm showing it to you now because I think some of you are really focused on it. It's not that I don't read any of it, but you need to take it with a grain of salt. They're not there to give you financial advice or investment advice. They're there to get clicks on their articles, and we just need to keep that in perspective. Now, having said all of that, I want to get to a big question that I've received from a number of people. Is now a buying opportunity? I got this question from an email from someone who has 5 or 10,000. Should they put that in index funds? And it's a common thing that you hear when stocks decline rapidly. And it kind of makes sense. The S&P 500 was up here. Now it's down here. Isn't that sort of the definition of a buying opportunity? And I want to answer that question in a couple of ways. First of all, I think for long-term buy and hold investors, you should not do anything different. Whether you want to call this a buying opportunity or not, I'll leave that up to you. You should have an asset allocation plan. You should stick to it. And if you're making, monthly investments in your 401k or your IRA or both, you should continue to do that. When someone comes to me and says, I've got $10,000 or $100,000, should I invest it in the stock market now? My first question to them would be, well, why wasn't it already in the stock market? What's your asset allocation? What's your allocation between stocks and bonds? I don't think you should change it just because the market has fallen by 20%. If it's a well thought out asset allocation plan that's consistent with your age and your retirement plans, for example. So why is that money out of the market to begin with? That would be the first question. I think the benefit of a plan is that it takes the emotion out of your decisions. We have an asset allocation plan, my wife and I. It's 70% stocks, 30% bonds. And so there's no emotion. There's no, what's the stock market doing today? We rebalance about once a year. And that's our asset allocation plan. And it's going to stay there. I'm not going to change it because the market's gone down by 20% any more than I would change it because the market goes up by 20%. And so that's the first thing. But the second thing is, I think, again, we need to zoom out. Stocks aren't cheap, right? Let's take a look. As I mentioned before, if we go back up to the S&P 500 and we go out, I mean, yes, they've fallen from highs, but I mean, they're back to, let's say, roughly where they were in December of 2018. I wouldn't necessarily call that cheap, but more importantly, if we go over to the S&P 500, and I can drop this, this is the Shiller website. This is not the Shiller PE. We can look at that. But this is the PE. It's currently at 19. The mean is just under 16. So if we're going to use price to earnings, and for those that aren't familiar, price to earnings is simply the price of a stock, let's say price per share divided by earnings per share. And as the PE goes higher, stocks are kind of generally considered to be more expensive. It's not the only way to measure valuation, of course, but it's certainly a popular one, and I think it's good enough for our purposes. I mean, right now we're at 19. The mean is under 16. So no, I don't think the S&P 500 is necessarily cheap. I think in light of current interest rates, it's probably fairly valued and within some relatively wide range. But I don't think it's a screaming sale, at all. And in fact, if you go to the Shiller PE, which is right here, which takes a 10-year inflation-adjusted average, they've got that at 23 with a mean of 16 or just under 17. So if someone were to say to me, I think it's a buying opportunity, my question would be, why do you think that? If the answer is, well, because stocks are down 20%, I don't think that necessarily makes it a buying opportunity. Again, I would continue to do what you're doing with consistent dollar cost averaging, buying and holding. But if I had money that I was waiting to invest in something, I'm not sure that I would see the current market as a screaming buy. Now, having said that, I do think there are some industries that are quite attractive. And for me, probably the biggest one is banking. I own shares of US Bank. It's got a yield of over 5% with a PE under 8. Again, it's a pretty cursory analysis, but I think for our purposes, it kind of gives you a sense. Citibank, yield of about 5%. Its PE is under 5, and it's trading on tangible book. Its tangible net worth well below 1. Other banks, JP Morgan, it's got a yield of over 4%, a PE of 8, or just under 9. You can look at Bank of America. Wells Fargo, its yield's been high, 7.7%. So, if you're investing in individual stocks, I would view some things as a buying opportunity. Again, not because of recent price moves in the sense that I think they'll go back up. Banks could continue to flounder for months or years, as far as I know. But if I'm just looking at the intrinsic value of some of these companies, I think they're, in my opinion, they're pretty attractive. It doesn't mean, though, that if you were to buy them today, you could lose a lot of money in the short term. I would not buy any of these companies if I weren't going to stay in the investment at least 5 years, which is sort of my definition as a minimum of a long-term investor. So is now a buying opportunity? Well, again, I think it's a great opportunity to keep doing what we're doing, which is what I've done, continuing to contribute to the 401k and invest it according to my asset allocation plan. I don't think the S&P 500, I certainly wouldn't call it cheap, even with the 20% decline. I do think some companies and some industries have probably become buying opportunities, but I'm guessing for most of us, you're probably not investing in individual stocks. And if you're not, to me, I wouldn't change a thing. I'm certainly not changing a thing. Now, that gets me to the last two questions, and thank you all for hanging in there with me. The first is now a great time to start investing? I think it is a fantastic time. Now, I think any time is a great time to start investing, but I think now is particularly a good time, and here's why. As we all know, the market is extremely volatile. That's, I guess, call me Captain Obvious. That's an understatement. And we need to learn how to deal emotionally with that volatility. And when you just start investing, at least if you, like I was now almost 30 years ago, I didn't drop $1 million into the stock market. I think I put $50. That's what I had, or whatever I could contribute to the 401k. So if you're new to investing, you're likely going to be investing in your 401k at work or maybe an IRA. And the money, of course, is important to you, and it may be a lot to your monthly budget, but it's not a lot in terms of saving for retirement. And learning to deal with the emotions of a volatile market, I think, is very important. And the sooner you can do that, the better. Now, it changes. If you've got $1,000 in the market and you lose 20%, trust me, it's very different than if you've got $100,000 in the market and you lose 20%, or $1 million in the market and you lose 20%. So don't ever assume you've got it all figured out. As you move through life and your portfolio grows, the emotions tend to get a little more intense. But you got to start somewhere. I think this is a great market to start in. And if I were starting today and I had maybe $50 a paycheck to put in, or 25 or 100, I would probably just put it all in an S&P 500 to start with. I'd wait till I build up some amount of money before I worried about diversifying. And I would actually look at my portfolio, maybe not every day, but certainly every week. I want to see the losses that come in. I want to feel those losses or the gains. And I want to understand how I'm reacting to that emotionally. It'll be a great opportunity to learn about yourself and about investing. And you won't be doing it with mountains of money. I mean, certainly the money is important to you, but it's a great opportunity when you're just starting out, investing relatively small amounts of money, to understand how the markets work and how your emotions work. So yeah, I think it's a great time to start investing. The last thing I want to mention in this video, that I think has probably gone longer than 20 minutes, is retirees. Now, if you're retired or nearing retirement, you may be saying, Rob, this is great. I get all the benefits, but I'm not contributing anymore. I'm not buying any more shares, so I don't get the benefit of a bear market. And I'm not reinvesting my dividends. I'm pulling them out to live on, right? And share buybacks, I can't eat share buybacks, so I don't really care about whether Apple is buying back shares or not. I get it. So what I'm going to do is another video. I'll announce it on the Facebook page. So follow the page, you'll get notice of it. I'm going to do it later this week, and it's going to be focused entirely on my views and talking about, kind of like what we've done today, how retirees or those nearing retirement should think about this kind of market. I'm actually wrote an article for Vanguard. It was supposed to be published a few days ago, and the market craziness, they pushed it a little bit because it's not about the market. It's about what's called the 4% rule, which is important to retirees. So if you're not familiar with it, definitely join the next video. Again, it'll be later this week. But we're going to walk through how to think about your nest egg in retirement, how I will think about it as I get closer and closer to that time. And but I will say this. I think regardless of whether you're in retirement or not, you shouldn't invest money in the market that you're going to need to spend in the next 5 years. I wouldn't go out and buy a dry cleaner with money that I needed to spend within the next 5 years, or a coffee shop, or any other real life business, brick and mortar business. I shouldn't go buy shares of Apple or the S&P 500 with money that I'm going to need in the next five years. And that's true whether the money is going to go to a down payment on a house, a vacation you want to take, or to live on because you're in retirement. Now, yeah, 5 years is a little arbitrary. I mean, some might need a little more cushion than that to feel comfortable. 5 years is not set in stone. There's no scientific analysis really, although if you look at market recoveries, you can see that most of them recover within 5 years. I think the Depression is one exception to that. But the point is, with that kind of cushion, it gives you time to ride out bear markets, and certainly markets that go into correction. So I think it's important at any point in life. We don't invest money that I know we're going to need to spend in the next 5 years, but that's even more important, I think, for those in retirement. Again, in the video later this week, I'm going to go into a lot more depth and give you some things to think about as it relates to any bear market, but this one in particular, for those that are either in retirement or near retirement. So thanks for hanging in there. That's kind of what I had to say. I'm happy to check out your comments and respond to anything, any questions. Tell me what I missed. Here's one from Mike. Would like your thoughts on how and when to reallocate your portfolio. Great question. Should you rebalance and when? I look at it just like I look at an asset allocation plan. What I want to do is take my emotions out of the decision. And I don't want to have to think about it over and over and over again. Is now the time to rebalance? Should I do it now? So just like an asset allocation plan, I set it and forget it. It adjusts a little bit as I get older, although our 70-30 is probably going to stay where it is for maybe forever. But it's the same thing with rebalancing. So what I tend to do is just rebalance once a year. There's a lot of studies on whether you should rebalance more often, less often. I don't think that's really important. If you want to rebalance once a quarter, twice a year, once a year, even once every other year, that may be a little long for me, but I think the real important thing is to pick something and then stick with it, whether the market's going up, going down, to stick with it. And that way, you're not letting the emotions cloud the decision. And yeah, I just find it just easier. Now, if you've got your asset allocation plan and you're rebalancing back to that plan, if you see a big down market like this, or maybe a big bull market, and you want to get out of stocks and reallocate back into bonds, or a bear market, get out of bonds and reallocate to stocks, I think that's fine. Again, I tend to just come up with a plan and stick with it. But as long as you're reallocating back to your asset allocation plan, where I get nervous is when people say, well, I think 80-20 was the wrong asset allocation. So in the middle of the kind of market volatility that we've seen recently, I'm going to change my asset allocation plan. Look, I'm not here to tell you not to do that. That's obviously your call. But I find it, for me anyway, it would be very difficult to convince myself that I were doing that without emotion, without the fear kicking in. And so if you're rebalancing back to your planned asset allocation, and it's not having any tax consequences, for example, because it's in a retirement account, that's fine. Again, I tend to just pick one time period and stick with that. But in market extremes, I might reallocate more than once. I might step out of that plan, but again, only to go back to my already predetermined plan, not to come up with a new plan. So a couple people, I guess Eric asked sort of the same question. I think it's similar answer. I mean, another way to think about that, let me kind of give you some advanced, I guess, I don't know if this is advanced, but this is how a friend of mine does it. He doesn't have a time period. He doesn't say, I'm going to rebalance once a year. He says, I'm going to rebalance. His formula is somewhat complicated. He rebalances each asset class when it moves one standard deviation away from the mean for that asset class. Now, for some of you, you're like, that's brilliant. And others are like, standard deviation? I've got a headache. I don't remember what that is. The point is, you could rebalance. You could make it simple. When your allocation goes, say, 3% or 5% off. So if you're, I think Eric he says 40-60. I don't know which one is stocks, which one's bonds. Let's assume it's 60% stock, 40% bonds. He could say, well, if that gets off by, pick a number, 3% or 4%, then I'll rebalance. So what will trigger my rebalance is not time, but movement in the market. And then you could end up rebalancing any number of times during the year or not at all. And that's a perfectly valid way to do it. What else do we have? I think I've covered everything. Happy to answer any other questions or cover any other topics you might have. Let's see. Wow. So I'm looking at Eric's comment. His plan is 40-60, but he's currently 28-72. So if that were me, I would rebalance. That's way off the mark. If I'm reading that correctly, that's 12 percentage points off the mark. Again, I don't know which one is stocks and which, 40% stocks, 60% bonds. So that's a very conservative portfolio. But yeah, if my allocation, like I'm 70% stocks, 30% bonds. So if my stocks were, let's say, up to 82 or down to, if I can do the math right, 58, I would absolutely be rebalancing. Again, I can't give you specific advice, but that's what I would do, because at that point I would feel that I'm way off my allocation plan, and I don't know. I'd have to be asking myself, why am I not rebalancing? Am I changing my plan? I mean, that might be the answer, but yeah, that's pretty far off. So Charles says, I dollar cost average every 2 weeks. I've seen a lot of chatter about accelerating their yearly DCA to next 3 to 6 months. Thoughts? Yeah. So the idea there is, if you're contributing to an IRA or a 401k, of course there are contribution limits. And so if you're like me, I tend, like with the 401k at Forbes, I tend to just break it all up and max out over 12 months. Charles' question is, given the current market, should I speed that up? Now, there's a couple things to consider there. First of all, you have to make sure if there's employer match, that it's not messing up the match. You will not get the full match if you accelerate the contributions. So you want to find out from HR or from the plan administrator if that's the case. So that's one thing to think about, again, if you have an employer match. The other thing is that will accelerating now be a good move or not? Well, I'll tell you at the end of the year. I mean, what you're really asking me, or one might argue that you're asking me, is what will the market do for the rest of the year? I have no idea. Now, if you look at studies, they tell you it's better to front load your 401k, again, putting aside the 401k match issue. It's better to front load, say, a 401k or 403b early in the year if you can. And it's better to do the same thing with an IRA. But why is that? Well, it's because in most years, the market's up, right? But not every year. So again, my approach to that would be to come up with a plan. You're going to hear this like a broken record. Come up with a plan and stick to it. If your plan, again, putting aside the employer match, which is an important issue you want to make sure of, but assuming that's not affecting the decision, if my plan is to accelerate as much as I can, then that's what I would do every year. I would just do it every year, and I would say, okay, some years I'm going to be wrong, if history is any indication, but most years I'm going to be right. And, remember, I mentioned the market correction at the end of 2018. It was almost a bear market, but not quite. But do you remember January of 2018? January of 2018 was another market correction. And when we started that year, everyone was like, oh, the bull market's over, and it's going to be terrible. Well, and then, of course, it took off and was really strong, and no one really predicted that. But then we hit another correction, and it went down at the end of 2018. And so talks of a bear market again, but then what did it do? It went back up. And of course, now here we are. So I try not to make decisions. I try to remove from my decisions what's going on in the market. And the only way I know to do that, for me, maybe some of you are better at this than I am, but the only way I can do it is to come up with a plan and stick to it. And Charles then asks, Eric is saying he's going to retire this year, so he's being very conservative. Well, Eric, you'll want to listen to the next video when we talk about retirement, because we're going to talk about the 4% rule. One thing that folks might not realize, the 4% rule initially came out, a guy by the name of Berger in 1994, and we're going to look at that in some detail in the next video. But the thing to keep in mind is that the 4% rule assumes an asset allocation that's at least 50% in equities. So I'm not telling you to change your allocation at all, because there's a lot of other factors that go into it. Other sources of retirement income. Do you have access to a pension? Are you going to work part-time in retirement? There's all kinds of questions that go into it. But just from the 4% rule perspective, he assumed at least 50% in stocks. And then to Charles' question, to follow up on Eric's question, what's your rebalancing emergency threshold? I confess, Charles, I don't know what you're asking. So I'm not sure what you mean by that. My emergency fund or something else? If you can let me know, I'll give you my 2 cents, worth every penny, I might add. And I think I've covered all the questions. My mom is watching, by the way. She's the one that said, I love you, Mom. She stalks me on the internet. It's a thing. It's lovely, really. Hi, Mom. I have had a lot of people ask me what they should do. My mom wanted to know, since she stalked me, I'm going to stalk her. Her question the other day was, Robert, should I take my money out and put it under my mattress? I said no, by the way. All right. I think I've covered everything. So again, I'm going to do the next video. I'll put in the Facebook group when. It's going to be in the morning. Today is Tuesday. I'll probably try to do it Thursday, but if not Thursday, Friday. And we're going to cover how, as folks in retirement or nearing retirement, should think about the current market. I'm going to talk a lot about the 4% rule. It's an easy rule to understand, but there are a lot of assumptions underlying it that not everyone really appreciates. And so we're going to cover that, and I'll give you some of my thoughts on that. So appreciate you watching, and until next time, remember, the best thing money can buy is financial freedom.